Hello friends. Welcome back. In this video we will continue the fundamental analysis course. In previous video, 3 lessons were renaming. So this time we will discuss about the below lessons. First is fundamental factors that affect currency values. Second is where to find forex news and market data. And third is market expectations of news and their impact on currencies. So let's begin with the fundamental factors that affect currency values. There are several fundamental factors that help shape the long-term strength or weakness of the major currencies and will affect you as a forex trader. We've included what we think are the most important for your reading pleasure. Economic growth and outlook. We start easy with the economy and outlook held by consumers, businesses and the governments. It's easy to understand that when consumers perceive a strong economy, consumers feel happy and safe, and they spend money. Companies willingly take this money and say, "Hey, we're making money. Wonderful. Now, what do we do with all this money?" Companies with money spend money. And all this creates some healthy tax revenue for the government. They jump on board and also start spending money. Now everybody is spending, and this tends to have a positive effect on the economy. Weak economies, on the other hand, are usually accompanied by consumers who aren't spending, businesses who aren't making any money and aren't spending, so the government is the only one still spending. But you get the idea. Both positive and negative economic outlooks can have a direct effect on the currency markets. Capital flows. Globalization, technology advances, and the internet have all contributed to the ease of investing your money virtually anywhere in the world, regardless of where you call home. You're only a few clicks of the mouse away, or a phone call for you folks living in the Jurassic era of the 2000s, from investing in the New York or London Stock Exchange, trading the Nikkei or Hang Seng Index, or from opening a forex account to trade US dollars, euros, yen, and even exotic currencies. Capital flows measure the amount of money flowing into and out of a country or economy because of capital investment purchasing and selling. The important thing you want to keep track of is capital flow balance, which can be positive or negative. When a country has a positive capital flow balance, foreign investments coming into the country are greater than investments heading out of the country. A negative capital flow balance is the direct opposite. Investments leaving the country for some foreign destination are greater than investments coming in. With more investment coming into a country, demand increases for the country's currency as foreign investors have to sell their currency in order to buy the local currency. This demand causes the currency to increase in value. Simple supply and demand. And you guessed it, if supply is high for a currency, or demand is weak, the currency tends to lose value. When foreign investments make an about face, and domestic investors also wants to switch teams and leave, and then you have an abundance of the local currency as everybody is selling and buying the currency of whatever foreign country or economy they're investing in. Foreign capital love nothing more than a country with high interest rates and strong economic growth. If a country also has a growing domestic financial market, even better. A booming stock market, high interest rates. What's not to love? Foreign investment comes streaming in. And again, as demand for the local currency increases, so does its value. Trade flows and trade balance. We're living in a global marketplace. Countries sell their own goods to countries that want them, exporting, while at the same time buying goods they want from other countries, importing. Look into the below graph. Have a look around your house. Most of the stuff, electronics, clothing, doggy toys, lying around are probably made outside of the country you live in. Every time you buy something, you have to give up some of your hard-earned cash. Whoever you buy your widget from has to do the same thing. U.S. importers exchange money with Chinese exporters when they buy goods. And Chinese imports exchange money with European exporters when they buy goods. All this buying and selling is accompanied by the exchange of money, which in turn changes the flow of currency into and out of a country. Trade balance, or balance of trade or net exports, measures the ratio of exports to imports for a given economy. It demonstrates the demand of that country's goods and services, and ultimately its currency as well. If exports are higher than imports, a trade surplus exists and the trade balance is positive. If imports are higher than exports, a trade deficit exists, and the trade balance is negative. So, exports greater than the imports equals trade surplus equals positive, plus, trade balance. Imports greater than exports equals trade deficit equals negative trade balance. Trade deficits have the prospect of pushing a currency price down compared to other currencies. Net importers first have to sell their currency in order to buy the currency of the foreign merchant who's selling the goods they want. When there's a trade deficit, the local currency is being sold to buy foreign goods. Because of that, the currency of a country with a trade deficit is less in demand compared to the currency of a country with a trade surplus. Net exporters, countries that export more than they import, see their currency being bought more by countries interested in buying the exported goods. It is in more demand, helping their currency to gain value. It's all due to the demand for the currency. Currencies in higher demand tend to be valued higher than those in less demand. It's similar to pop stars. Because she's more in demand, Taylor Swift gets paid more than Pink. Same thing with Justin Bieber versus Vanilla Ice. The government, present and future. The years 2009 and 2010 have definitely been the years where more eyes were glaringly watching their respective countries' governments, wondering about the financial difficulties being faced, and hoping for some sort of fiscal responsibility that would end the woes felt in our wallets. Instability in the current government or changes to the current administration can have a direct bearing on that country's economy and even neighboring nations. And any impact to an economy will most likely affect exchange rates. Where to find Forex news and market data? A quick Yahoo Googling, that's Yahoo, Google, plus Bing, search of Forex plus news or Forex plus data returns a measly 30 million results combined. 30 million. That's right. No wonder you're here to get some education. There's just way too much information to try to process and way too many things to confuse any newbie Forex trader. That's some insane information overload if we've ever seen it. But information is king when it comes to making successful trades. Currency price moves because of all of this information, economic reports, a new central bank chairperson, and interest rate changes. News moves fundamentals and fundamentals move currency pairs. It's your goal to make successful trades, and that becomes a lot easier when you know why price is moving that way it is. Successful Forex traders weren't born successful, they were taught or they learned. Successful Forex traders don't have mystical powers, well, except for Pip Crawler, but he's more weird than he is mystical, and they can't see the future. What they can do is see through the blur that is Forex news and data, pick what's important to traders at the moment, and make the right trading decisions. Where to find Forex news and market data? Market news and data are available through a multitude of sources. The internet is the obvious winner in our book, as it provides a wealth of options, at the speed of light, directly to your screen, with access from almost anywhere in the world. But don't forget about print media and the good old tube sitting in your living room or kitchen. Individual Forex traders will be amazed at the sheer number of currency-specific websites, services, and TV programming available to them. Most of them are free of charge, while you may have to pay for some of the others. Let's go over our favorites to help you get started. Traditional financial news sources. While there are tons of financial news resources out there, we advise you to stick with the big names. These guys provide around-the-clock coverage of the markets, with daily updates on the big news that you need to be aware of, such as central bank announcements, economic report releases, and analysis, etc. Many of these big players also have institutional contacts that provide explanations about the current events of the day to the viewing public. Reuters, The Wall Street Journal, Bloomberg, MarketWatch.com, Real-time feed. If you're looking for more immediate access to the movements in the currency market, don't forget about that 80-inch flat-screen TV in your bathroom. Financial TV networks exist 24 hours a day, 7 days a week to provide you up to the minute action on all of the world's financial markets. In the US, the top dogs are, in random order, Bloomberg TV, Fox Business, CNBC, MSNBC, and even CNN. You could even throw a little BBC in there. Another option for real-time data comes from your Forex trading platform. Many Forex brokers include live news feeds directly in their software to give you easy and immediate access to events and news of the currency market. Check your broker for availability of such features. Not all brokers' features are created equally. Economic calendars. Wouldn't it be great if you could look at the current month and know exactly when the Fed is making an interest rate announcement, what rate is forecasted, what rate actually occurs, and what type of impact this change has on the currency market? It's all possible with an economic calendar. The good ones let you look at different months and years, let you sort by currency, and let you assign your local time zone. 3 p.m. where you're sitting isn't necessarily 3 p.m. where we're sitting, so make use of the time zone feature so that you're ready for the next calendar event. Yes, economic events and data reports take place more frequently than most people can keep up with. This data has the potential to move markets in the short term and accelerate the movement of currency pairs you might be watching. Lucky for you, most economic news that's important to Forex traders is scheduled several months in advance. So which calendar do we recommend? We look no further than our very own babypips.com Forex economic calendar to provide all that goodness. If you don't like ours, which we highly doubt, a simple Yahoo Googling search will offer up a nice collection for you to examine. Market information tips. Keep in mind the timeliness of the reports you read. A lot of this stuff has already occurred and the market has already adjusted prices to take the report into account. If the market has already made its move, you might have to adjust your thinking and current strategy. Keep tabs on just how old this news is or you'll find yourself yesterday's news. You also have to be able to determine whether the Forex news you're dealing with is fact or fiction, rumor or opinion. Economic data rumors do exist, and they can occur minutes to several hours before a scheduled release of data. The rumors help to produce some short-term trader action, and they can sometimes also have a lasting effect on market sentiment. Institutional traders are also often rumored to be behind large moves, but it's hard to know the truth with a decentralized market like spot Forex. There's never a simple way of verifying the truth. Your job as a Forex trader is to create a good trading plan and quickly react to such news about rumors after they've been proven true or false. Having a well-rounded risk management plan, in this case, could save you some moolah. And the final tip, know who is reporting the news. Are we talking analysts or economists? Economists are the owner of the newest Forex blog on the block? Maybe a central bank analyst? The more reading and watching you do of Forex news and media, the more finance and currency professionals you'll be exposed to. Are they offering merely an opinion or a stated fact based on recently released data? The more you know about the who, the better off you will be in understanding how accurate the news is. Those who report the news often have their own agenda and have their own strengths and weaknesses. Get to know the people that know, so you know. Can you dig it? Let's come to the last lesson. Market expectations of news and their impact on currencies. There's no one all-in or bet the farm formula for success when it comes to predicting how the market will react to data reports or market events or even why it reacts the way it does. You can draw on the fact that there's usually an initial response, which is usually short-lived, but full of action. Later on, comes the second reaction, where Forex traders have had some time to reflect on the implications of the news or report on the current market. It's at this point when the market decides if the news release went along with or against the existing expectation and if it reacted accordingly. Was the outcome of the report expected or not? And what does the initial response of the market tell us about the bigger picture? Answering those questions gives us a place to start interpreting the ensuing price action. Consensus market expectations. A consensus expectation, or just consensus, is the relative agreement on upcoming economic or news forecasts. Economic forecasts are made by various leading economists from banks, financial institutions, and other securities-related entities. Your favorite news personality gets into the mix by surveying her in-house economist and collection of financial sound players in the market. All the forecasts get pooled together and averaged out, and it's these averages that appear on charts and calendars designating the level of expectation for that report or event. The consensus becomes ground zero. The incoming, or actual data is compared against this baseline number. Incoming data normally gets identified in the following manner. As expected, the reported data was close to or at the consensus forecast. Better than expected, the reported data was better than the consensus forecast. Worse than expected, the reported data was worse than the consensus forecast. Whether or not incoming data meets consensus is an important evaluation for determining price action. Just as important is the determination of how much better or worse the actual data is to the consensus forecast. Larger degrees of inaccuracy increase the chance and extent to which the price may change once the report is out. However, let's remember that Forex traders are smart, and can be ahead of the curve. Well, the good ones, anyway. Many Forex traders have already priced in consensus expectations into their trading and into the market well before the report is scheduled, let alone released. As the name implies, pricing in refers to traders having a view on the outcome of an event and placing bets on it before the news comes out. The more likely a report is to shift the price, the sooner traders will price in consensus expectations. How can you tell if this is the case with the current market? Well, that's a tough one. You can't always tell, so you have to take it upon yourself to stay on top of what the market commentary is saying and what price action is doing before a report gets released. This will give you an idea as to how much the market has priced in. A lot can happen before a report is released, so keep your eyes and ears peeled. Market sentiment can improve or get worse just before a release, so be aware that price can react with or against the trend. There is always the possibility that a data report totally misses expectations, so don't bet the farm away on the expectations of others. When the miss occurs, you'll be sure to see price movement occur. Help yourself out for such an event by anticipating it, and other possible outcomes, to happen. Play the what-if game. Ask yourself, what if A happens? What if B happens? How will traders react or change their bets? You could even be more specific. What if the report comes in under expectation by 0.5%? How many pips down will price move? What would need to happen with this report that could cause a 40-pip drop? Anything? Come up with your different scenarios and be prepared to react to the market's reaction. Being proactive in this manner will keep you ahead of the game. What the heck? They revised the data? Now what? Too many questions in that title. But that's right, economic data can and will get revised. That's just how economic reports roll. Let's take the monthly non-farm payroll employment numbers, NFP, as an example. As stated, this report comes out monthly, usually included with it are revisions of the previous month's numbers. We'll assume that the U.S. economy is in a slump and January's NFP figure decreases by 50,000, which is the number of jobs lost. It's now February, and NFP is expected to decrease by another 35,000. But the incoming NFP actually decreases by only 12,000, which is totally unexpected. Also, January's revised data, which appears in the February report, was revised upwards to show only a 20,000 decrease. As a trader, you have to be aware of situations like this when data is revised. Not having known that January data was revised, you might have a negative reaction to an additional 12,000 jobs lost in February. That's still 2 months of decreases in employment, which ain't good. However, taking into account the upwardly revised NFP figure for January and the better-than-expected February NFP reading, the market might see the start of a turning point. The state of employment now looks totally different when you look at incoming data and last month's revised data. Be sure not only to determine if revised data exists but also note the scale of the revision. Bigger revisions carry more weight when analyzing the current data releases. Revisions can help to affirm a possibly trend change or no change at all, so be aware of what's been released. So guys, this course is completed here. In next video we will start another course of high school, which is currency crosses. So stay tuned.